Welcome everybody to the first episode of the GrowingAU show, where we are going over the ups and downs, the ins and outs of the stock market to help you find the best way to have your money work for you. Got really value-packed episode for you today, talking about perhaps one of the most caffeinated companies of all time, Starbucks. They've had an interesting couple of years in the stock market, and frankly, an interesting couple of days as well. We're going to go over all of it today. So sit back, relax, maybe grab a latte, and let's jump on into the video to find out whether the returns of Starbucks are as big as their venti drinks. Let's get into it. Let me first say that all the information included in today's episode, as well as 10Q forms, SEC filings, annual reports, quarterly reports, and everything else you need to know about Starbucks' monetary and financial standing, can all be found in a typed-up stock report that'll be linked below and found on our website, GrowingAU, that will link all of the experts and information that we discuss in today's episode. As always, please conduct professional financial advice before making any financial decisions. And with that being said, let's jump on into the episode. All right, so Starbucks today at $77.02. 4 cents right now, down 2.12% and down $1.69 today. Kind of an interesting day for Starbucks, and the reason this is happening is quite, we can talk about that a little bit. The earnings call yesterday for quarter two was basically lackluster at best. And there were definitely some things in there that were not super great. We have a full breakdown of Starbucks earnings call that you can find on GrowingAU, both on our website and on our YouTube page. That'll also be linked down below if you're interested in learning more about the earnings call. We will talk about quarter two in just a second, but before we do that, let's talk a little bit about the history of the company. So, Starbucks was founded by its three founders in 1971, and it wouldn't be until about 15 years later in 1986 when Howard Schultz would procure the company and start building it into the brand that many people have come to love. In fact, when Starbucks first opened, they didn't even serve espresso, which has now become one of their core beverages. So, Starbucks IPO'd in summer 1992 at $17 a share, but by October of that year, due to split adjustments, dropped to 34 cents a share in that time period. This period would cause a large increase of momentum buyers and short sellers to come along. Going past that, Starbucks would have its ups and downs, kind of crashing in 2001 after 9/11 and then rising to new highs in 2003, right about the $6 point, to new high in 2015 in the high 60s. Despite the upturn of the market, Starbucks would really have kind of an underperforming couple of years until 2018, at which point they would continue to rise through 2019, at which point they would hit an all-time high of $99.72 before coming down and crashing in February 2020, in large part due to the coronavirus outbreak, which had a huge effect on the company. We'll talk about that a little bit more in just a second. So bringing us to the present, let's take a look at what Starbucks is doing so far. So $77.16 is the current price per share. They've had an annual high of $99.72, an annual low of $50.02, with a volume of 14.95 million, an average volume of 12.42 million, a market cap of 90.54 billion, and a dividend yields of $2.11. As far as fiscal year 2019 is concerned, if we're looking at the EPS, in Q1 it was 53 cents per share, Q2 $1.12, Q3 66 cents, and Q4 74 cents. That's courtesy of macrotrends.net. So looking at all the numbers, what do the bulls have to say about Starbucks? The people that really think Starbucks is going to continue to take off, what do they have to say? And this is courtesy of Morningstar.com. The bulls say that Starbucks is an adaptive company. They're adapting to evolve consumer behaviors through the brand, which transcends channels as well as the digital flywheel, social media, delivery partnerships, and loyalty program improvements. Food beverage innovations and upscale store redesigns can elevate the Starbucks customer experience, unlock new day parts, and bolster unit-level productivity metrics. Despite ambitious growth aspirations, we believe Starbucks can eventually reach a 60% dividend payout ratio over the next decade, implying low to mid-teen average annual dividend growth results. Bulls think that Starbucks is going to be able to continue to adapt and grow over time. How about the bears? They are not so sure. They are concerned with a few different things. Number one, with the low to non-existent switching cost from a customer coming from Starbucks to any other commercial coffee brand, that being McDonald's, Tim Hortons, Dunkin' Donuts, with low to non-existent switching costs, and in some ways, those other mainstream coffee brands actually offering products at a lower price, they worry that the customer has really no incentives to stay with Starbucks and could continue to switch over. They're also worried that Starbucks offshoot brands like Teavana, Princey, Evolution Fresh may not evolve into successful complementary brands to Starbucks. We actually saw this before in 2000 2008, when Howard Schultz took over the company again as CEO, one of the main reasons he did that was because he felt that the company was getting away from its initial core of the brand, which obviously is the coffee. They're worried about that possibly happening again, that these offshoot brands, Teavana, Evolution, Princey, could really just take away from the central core of the Starbucks image and brand. Also, they worry that the coronavirus-related restaurant closures are going to take a long time to recover from, and that consumer behavior is going to take a long time to kind of move back to normal. But obviously, the experts can say what they want. People can predict everything they want to predict, but really it just comes down to the numbers. What are we expecting for Starbucks in 2020? Well, according to Forbes, Starbucks in 2020 was expected to report revenue of $28.2 billion, which would exceed the previous year by a whopping 6.3%. Are they on track for this? Well, reported by CNBC on Q1, they had a 79 cents EPS compared to a 76 cents EPS, a revenue of $7.1 billion, which was right on point with the expected revenue of $7.1 billion, and a global same-store sales up 5% versus an expected 4.4%. Great Q1 for Starbucks. They did really well. Believe it or not, though, the actual price of Starbucks stock was not greatly affected by the Q1's report and actually went down a little bit. The reason for this is that Kevin Johnson said in the Q1's report, we see what's already happening in China. We're losing sales in China. Things are not going well, and we're expecting that to affect us into Q2. And the market reacted to that. They didn't care much for these kind of upticks in the fact that they had a higher EPS or a higher revenue. All they heard was the future is not going to look super bright or possibly could be bad for Starbucks. And as we know, the market reacts in the future, not the current. So unfortunately, the Q1 results as far as the shares were concerned, kind of lackluster again. Now, how about Q2? Well, Q2, we started to see some problems. The expected earnings per share in Q2, EPS, was 34 cents. Unfortunately, though, the EPS was only 32 cents. That did not sit well with the shareholders. The revenue of $6 billion in Q2 was down 5% as compared to the previous year. The earnings call yesterday, we have a full video on it, as I said, but it was a lot of damage control. The problem that Kevin Johnson and the other heads of Starbucks are worried about is that the negative results are going to continually expand into Q3 and even possibly into Q4, leading to a possibly negative year for 2020. Whether or not that's going to happen, it's hard to say, but even with all of that's happening, what are some other experts saying about Starbucks? Do they think that it's going to be able to rebound nicely? Do they think that it's worth investing in? Well, joining us from the Motley Fool, Fool.com, we have Daniel Sparks, MBA, and he says that Starbucks has had a rough run recently, with shares essentially going nowhere over the last 3 years, that being the 2015 to 2018 area. He says that an aggressive capital return program paired with management efforts to run a leaner operation makes Starbucks a cash cow worth betting on. Put another way, Starbucks has morphed into a solid dividend stock. He believes that Starbucks could keep growing over time. That is a check mark from the Motley Fool over at Fool.com. Thank you, Daniel Sparks. Over from Investors Business Daily, though, Investors.com, Scott Latonen, who is a portfolio manager and contributor, he has some different things to say. He says, amid the current stock market correction, Starbucks shares are nearly 40% off their 52-week high on March 16th. Starbucks stock plunged as much as 16.9% to a low of $58.11 amid the day's stock market crash. So, Starbucks is not a buy right now, but the coffee giant could always shape up a new base, offering a new buy point. I would say that's a pass from Scott Latonen over at Investors Business Daily, but he is saying that, look, Starbucks is not an intrinsically bad company. They're just not necessarily in a great place right now. And honestly, looking at Q2 and what is possibly projected by the Starbucks staff in quarters 3 and 4, he might be right. So I think the kind of, I would say, trepidation on Scott Latonen's part may be wise. So let's look over one more source at Investopedia. Alan Farley, he's the author of Master Swing Trader, which was published by McGraw-Hill 2000. He says misfortune of rivals in Starbucks will help in the coming quarters, saying that small competitors will bankrupt. Starbucks has a sizable cash hoard that will ensure its survival if the pandemic keeps the stores closed through Q2, which it really did. And with the potential demise of key rivals, the company could bounce back in a commanding market position after the pandemic runs its course. The hard part, though, and I agree with what Alan Farley is saying, the hard part, though, as discussed by the earnings call, is we just don't know how long this pandemic is going to be. We don't know how long it's going to take for the pandemic to run its course. We do talk a little bit more about that in the earnings call video, though, if you are interested. So really it kind of comes down to looking at the numbers, looking at what the experts are saying, looking at what the company's saying, looking at how the stock has done as far as the market's concerned, and really starting to make those informed decisions based off what we know. Again, from CNBC, Arjun Kripal, he's telling us about something big that has just happened with Starbucks, and I wanted to bring it to your attention today. Starbucks has just partnered with venture capital firm Sequoia Capital in China to co-invest in technology business in the world's second largest economy. The coffee chain said that along with co-investments, it will look to form commercial partnerships with next-generation food and retail technology companies. The partnership allows Starbucks to tap into the most dynamic Chinese technology entrepreneurs in order to delight our customers with meaningful innovations created in China for China. And that is from Belinda Wong, the chairman and chief executive officer at Starbucks China. And that was released in a press release. So the one thing that you need to know about very clearly is that Starbucks, Kevin Johnson, is putting a lot of effort into China. They are really focusing on their emerging markets in China, opening a new roasting plant in Asia, which will be the biggest in that part of the world, set to serve upwards of 6,000 stores. They're looking at opening 500 new stores in 2020, which was 80% of their goal. They're looking to continue to expand and really capitalize on that market, as was reported by Arjun Kapal, by having Chinese-specific, region-specific items available, having alternate milk items available, alternate protein items available. They're doing a lot to really capitalize on that Chinese market. And what they've done since China was affected by the coronavirus through the majority of Q2, they're into that recovery phase. Starbucks has taken that time to really build up their recovery procedures, so now they can bring them in a monitor, adapt approach into the US, Canada, Japan, and their other markets. They really took their awful situation and found the best advantage they could to really find the best way to continue to move through these trying and really unprecedented times for their company. I believe that Starbucks is going to continue to be able to put out a wonderful product. They're going to be able to keep their customers, their partners, and their shareholders happy, safe, and just do everything they can. And understand that they can't force it right now, that there's so much happening out there that they try and force and just open things up and pretend things went back to normal, it would probably cause more harm for the company. So they're using that monitoring adapt approach. They understand that taking some small losses in the short run is better than taking major losses in the long run. And I think that is awesome from the CEO and CFOs of Starbucks, really being able to look ahead in that way. Let me know, number one, if you go to Starbucks, what is your favorite drink? And number two, if you're going to invest in Starbucks now that we have a little more information on them. If you want more information on the stock market, starting to know the questions to ask, starting to know what the lingo means, some of the basic equations, what the charts mean, if that is something that's interesting to you, there'll be a link below to our website where you'll be prompted to sign up for our email list. Signing up for that email list will give you a free, I say free, no money whatsoever, 8-page ebook that'll give you some of the basic definitions, basic equations, and some of just the basic terminology that you need to know when it comes to beginning analyzing the stock market and investing. That is completely free. Go ahead and check that out. And also, by signing up for that email list, you will get all of our stock write-ups the minute they are put on our website. They'll be sent directly to you. So I hope you found value in this episode. If you did, consider giving a like and a share. Thanks for tuning in for the first episode of the Growing AU show. Subscribe if you really loved it, and we'll see you next time.